Hi, everybody. Let's get started. Actually, welcome. It's Money Monday, the first Monday of March. Welcome, y'all. We're here. Hi, Rashana. Hey, Ben. Let's chat about investing today, y'all. Look, we got Lorenzo in the house, too. And y'all are on time. I appreciate y'all. Let's get to it. If I can figure out how to take this graphic off. Welcome to Money Monday. I'm your wealth best friend. If you need to know anything about me, just know that I've got your best interests at heart. Period. That's it. That's all. I'm telling you what I've lived and my experience, my education. I'm sharing it all. And that's what Money Monday was intended to be. Some of us are flying blind. We're the first to do some of the things that we're doing, starting businesses, going to college in our family. So you don't know what you don't know. And because of that, it's much easier to fall into traps. So I'm here at least to try and help you get out of those traps or stay away from those traps if possible. But if nothing else, to be a cheerleader in your corner for whatever you're going through. So welcome to Money Monday. Today we're talking about investing, and this was kind of spurred because I had a conversation with my grandma. Now give her some grace. She is 90 years old. So charge it to the game, not her heart. But I told her that I'm really into investing in multiple ways outside of the traditional real estate, which is that was her go-to for wealth. Hey. And when I told her that, the first thing that she said was, oh, but the stock market goes down. Now, I feel like I say this a lot, but I'm going to reiterate it. I want to make sure that the people that you are choosing to advise you and to be your advisors are at least in your generation. Like, it doesn't help me to have my grandma and her baby boomerness advise me on a millennial need to invest. She has a pension, an inflation adjusted pension. That means her employer took on all of the risk of investing and she didn't have to worry about it. She never had to look at a 401k if she didn't want to. It wasn't an option. She invested, and if she did so, it's on the side for pleasure. It's not because your retirement depends on it. Whereas with us, the millennial generation, 401ks are all we got, or investment vehicles where we take on the risk. That's all we got. So we have to know how to invest. And I want you to make sure that you're looking at where the advice comes from. Somebody who has a degree that costs them $5,000 max isn't going to be a great guide for you when you're looking at your first degree costing $100,000. That one right there cost me that. I got grants and scholarships, so it didn't end up costing me all of that, but that's what the receipt said when I got it. And that was decades ago. So I can't imagine what it costs now, and we're not even going to talk about that one. So just note your source, understand that everything changes, and you've got to take advice with a grain of salt, because your experience is going to be unlike anybody else's. What works for them may not work for you. It's nice to know what they've gone through, to hear their experience, but just know your experience may differ. It may be the same. So with investing, for me, I feel like it's a necessary in multiple ways. Either you're investing for retirement, you're investing so that you can meet your goals, or you're investing because it's something you just genuinely like. Hey, everybody. But But it's based on you, not society. Don't check the boxes. It don't work out well. And I'll leave this conversation in the stock investing arena because there's so many other things that you can invest in. We could be here all day. Just know that the concepts apply to every type of investment, even if we're talking about real estate, if we're talking about baseball cards, Pokemon cards, clothes, shoes, like collectibles, Birkins, whatever you want to collect, whatever you want to invest in. As long as you have a plan and it works for you, so be it. But where do you get started when it comes to investing in the stock market? I always tell people that your employer, if you're a W-2 employee, normally has an investing account that you can use to get started. If you don't have an employer that doesn't have a retirement account, you can set up one. But the first thing that you should do is decide what you want to invest in, what it's for, and how long. And for real stock market investing long term, because remember, I am a long-term investor. I am not a day trader. I am not going to tell you to be in and out of the market. That works for some. Not what I'm here for. If you don't have at least 3 years to leave the money in that you plan to invest, don't invest. Don't. You need more time than that. 5 years is nice. So if you're saving for a house and you got 5 years that you're gonna build up and want to invest in the meantime, you can do that. But take time to research what you want to invest in and make sure that you're diversified. So what that means is, before I even open up the account, what am I doing? I want to invest in index funds. I've heard a lot about that. Now, you guys know me. I know exactly what an index fund is, but I also know that there are thousands of them out there. I need to start narrowing down what type of index fund I'm going to go for. And you can choose it by things around your house. If I want to invest in Amazon and the Googles, I'm going to look for a blue chip, large corporation index fund. I'm going to look for something that has very, very low fees. And what you can do to try and find that is go to the prospectus on the index funds and find out what their management fees are. They tell you all of this, the expense ratio, and put that into a calculator. Just Google mutual fund or index fund fee calculators. You'll find out how much that's going to cost you over the life of that 5 years that you're investing, or that 30 years for retirement. It'll help you see, okay, if I have a 1% fee, okay, I'm not making as much money. You know who's making money? The fund manager. So I'm not going to do that. I'm going to try something else. So once you figure out, okay, I've narrowed down what I want to invest in, you can invest in stocks based on things that you're buying. Like I bought Ivy Park. Maybe I want to buy Adidas. I bought Nike. Maybe I want to buy some Nike stocks. So you can do that too, but you can also find those in index funds. But you just want to diversify. Don't put all your money into one stock. Please, 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 please. Because then you're gonna have to deal with the rise and fall of that. There's no diversification. So if that stock's down, your entire portfolio is down, versus the index fund. You're investing in a collection of stocks. So it's less risk, less worry on your part. And then once you've got your index funds, feel free on the side, throw in some on your favorite stocks, favorite businesses that you plan to hold. Period. But you're still researching, mind you. I haven't told you to open an account. I haven't told you to throw money in. None of that. Now, don't spend too much time allowing this to keep you from opening that account and investing. But also ask around, talk to others, find your group that is talking about money, that's willing to have conversations like this. Find out what they're doing. If they're talking to a financial advisor or certified financial planner, find that out. Find out if they're doing the investing themselves. Find out what they know, their background. Talk to them about it. Then choose an account based on your goals. So that's either going to be the retirement account, that's going to be the brokerage account. I prefer traditional brokerage platforms over the Robinhoods and the other startups for fee reasons, for reporting reasons, but that's just me. It is much easier to get started and get it up and running, and a little less overwhelming to use the startup apps, but you also don't get access to all that the stock market has to offer when you do it like that. So after you fund your account, make sure that you are choosing a cash-based account. And I say that because with the GameStop issues and saga, there were a lot more people finding out, margin accounts, and hearing about margin accounts. What you need to know about margin accounts is that's just investing with debt. That's all that means. It means that the brokerage company is going to front you money so that you can invest with more money than you actually have in your portfolio. And you're buying options or futures, and you're buying contracts. So you don't actually own the stock. And if your account falls below a certain amount, then the brokerage company can call your debt, which means you're either going to add money to pay what you're supposed to have in your account, or they're going to sell everything. Meanwhile, my account that I've invested only what I have and no more, I don't have to worry about that. I don't have to worry about my debt account because you have 40% equity in your margin account, which means 60% of it. So, cash accounts. You want a cash account if you're going to actually invest in stocks and you want to own those underlying stocks instead of buying calls or puts or writing call or put options. It's much more risky to be a margin trader. And not something that I've gotten into because I'm on this. I don't want to be in debt and I don't want to use anybody else's money to do what I can do myself. But that's just me. Like I said, I'm just here for accountability. If you choose to margin trade, know the risks, know the rewards, understand that the majority of margin traders lose money. But that's it. That's all I want to tell you. So, now that you've got your account set up, because in this wonderful world, you've done your research, you know exactly what you're going to go for, you're going to buy, and you bought it. Now all you got to do, leave it alone. Don't touch it. Investing is more emotional than actual knowledge. It's hard to see your account fluctuate. It's hard to listen to the news and hear, this is a terrible day. The worst day since October, the worst day since an hour ago. Ignore it. You've done your research. Leave it at that. And go on about your day. This from somebody who has grown a 5-year-old's account from 0 to over $70,000. And it will continue to do what the heck it's doing because I'm not going to touch it. It has a purpose. I have at least an 18-year time span, more if she chooses not to go to college. which would be great. And even more if she chooses to go to college and she gets it for free. So just know that it's going to be okay. Just don't touch it. If you want more tips about how to invest and what to look for, what you should be paying attention to, I just dropped a new Business Insider article about just that. Best way to get to the article, if you're not going through a little link tree, is to just Google my name and Business Insider. I believe all of my articles come up, or check me out on LinkedIn. I try and put all of my publications there. I also have a new article on my blog, the Wealth Best Friend blog, about my article with the Skim about the racial wealth gap and how I'm teaching my family to invest to try and help break generational curses. And you can read all about that at the Wealth Best Friend blog. I'm going to circle through and see if we have any questions. I appreciate all of y'all for being here. I really, really do. And I'm hoping that you guys are already investing. Oh, Daily OJ, hey. How do you know the difference between the two when buying? And I'm assuming you're talking about margin versus the cash, or are you talking about index funds versus stocks, actual stocks? Margin, you'll know. There's a whole lot of disclosures that the brokerage account will make you sign, and make sure that they're telling you that you're investing with debt. I know it's very easy to just click through that stuff, but they do have to disclose to you that this is the type of account you're signing up for. I think even on Robinhood, margin trading is either a premium feature or it's something you definitely have to sign up for. They don't automatically give you a margin account, but they will ask you about it because it is a huge moneymaker for most brokerage companies, because you got to think you're doing a lot of buying and selling and trading. So it's much, much, much more lucrative than somebody like me, where it's like, I know I just want Amazon stock and I'm going to hold that be forever. They had one action on my account and that's it. Other than them getting to custody my account, which means hold the assets for me, they don't get anything from me. So they love margin traders. They love day traders. They love swing traders. They love anybody who's doing more trading volume than me, which is fine because I'm just sitting here racking up all the way to the bank. And if you don't believe me, you got to take my investing course, because I actually show you the money. Although that was last year, I use my own accounts to teach and show you how to set up these accounts. So I put my money where my mouth is. You can see it. Now those accounts, because last year was a wonderful year for a buy and hold investor, those accounts have gone up, I think, as much. I probably can buy, if I were to sell everything right now, just the profits from last year alone, I could probably buy a Model 3 cash. That's buying and holding. Never had to sell, trade, do any of that. So hope that answers your question about margin trading. I personally use Fidelity because it's the most robust platform, and they have financial advisors who I found are able to be kind of like me, your wealth best friend, and put your best interests over theirs. So I tell the story that one of my clients went to open a brokerage account at a large local bank, and they told her, no, we don't agree. You shouldn't learn to invest. Just let us manage it for you. And then she went to Fidelity and said the same thing. And they were like, yeah, we are looking forward to helping you open this account. If you have any other questions or decide that you want to do a managed account, feel free to let us know. But we wish you the best. Here's what you need to know to get the account opened. And I was just like, oh, so it can be done. A bank can care about you. So that's why I go hard for Fidelity versus a lot of the other platforms. I'm also in love with Ally Bank, but I tried their investing platform and it just didn't have access to all of the funds. Like I said, most of them will give you access to stocks and ETFs. I need a little bit more than that because I like mutual funds that are index mutual funds. So super, super low cost. They don't even do that much trading. So I'm giving you all the game that I got. If you guys have any other questions, I know we've gone over time, but I'm hoping it was helpful. Just know I will be back for Money Monday next week, and I'm around the IG world answering any other questions that you have. Thanks, y'all, for coming. I appreciate y'all. Have a good one.